Imagine being shown just one trading model that can replace absolutely all strategies and useless indicators you can find on YouTube and the internet. And no, this isn't just a catchy intro, it's actually true. I learned this approach from a team of professional traders on Wall Street with a proven track record of profitability. They achieve over 200% per year. And hedge fund managers use this method. In this video, I'm going to take a professional trading framework, which is the result of the work of some of the brightest minds in the market, including Nobel Prize winners. And I'll break it down into an extremely simple strategy with a single model that you can start trading today, with practical examples from the market. And I'll show you how I use this model. And I'll share trades that we made in our club with clients. The problem for most traders and investors isn't that they're not trying hard enough. The problem is that they study the market through chaos. They jump from indicators to smart money, from Fibonacci to secret methods, but still never understand why price moves at all. Because of this, trading turns into a series of random scenarios and outcomes where the results are unstable, even when it seems like the strategy is working. And the most dangerous thing here isn't even the losses. The most dangerous thing is the illusion of understanding. You can spend months searching for a strategy, testing it, getting some results, and sometimes even making money. That's why it seems to you that this strategy works, but in reality, as soon as the market changes, you start losing money again. So any profit ends up being only temporary. The second problem is even worse. When you don't understand the mechanics of the auction, you start focusing only on the visual picture, on the highs and lows, but completely ignoring the structure. Behind this picture, you miss the most important thing: where the market is right now, where it's in balance, and where it's out of balance and could move. And it's exactly in these places that those very trading opportunities are born, the ones that can actually make us money. So what is an auction? And how does the auction mechanism work? Let's start right from the basics. In game theory, there's something called auction theory. A direct auction, which is the classic type, a reverse auction, where sellers compete for the buyer, and a double auction, which is most similar to the financial market. In a classic auction, let's say you have a vintage car that you've decided to sell. There's a dealership acting as the intermediary, organizing the auction, and there are buyers with money who are ready to purchase the car. For example, the car is put up for an initial price of $100,000. So someone comes in and immediately says, "I'm willing to pay for this car, $110,000. In other words, they're willing to pay a slightly higher price than what was originally set. And that becomes the new price. Then someone else comes along and says, "Hey, I'll pay $120,000. So is it a deal?" And that's the new price. And the price keeps going up, continues to rise, as long as there's a buyer who's willing to pay more, who's ready to pay a higher price. And the difference between the previous and the current price is called the jump. Well, that's exactly what happens in financial markets. And unlike a regular auction, instead of a car, you have either futures contracts or securities that you're putting up for purchase or sale. And this process happens at absolutely every level of the price. So those same car sales are happening at every single price level that the asset passes through. The auctioneer or intermediary is actually the exchange, which is responsible for matching buy and sell orders. And then there's demand, which is expressed through these buy and sell orders. Let's imagine that the offers are called market makers or passive liquidity, and they are displayed in what's called the order book. And so at the top, you basically have sell limits or passive sellers. This is called the offer or ask. It's an auction of sell orders. They're waiting for someone among the buyers to accept their price and agree to pay a little more than the current price in the market. And at the bottom, we have buy limits are passive buyers, also known as the bid. They represent buyers, and they're waiting for someone to sell a little cheaper than the current market price so they can execute that trade. And again, these are just orders that exist in the order book. They imply the asset's liquidity, just like cars put up for auction. But that doesn't mean they'll be executed until someone shows up and says, "Hey, I'm ready to pay a higher price for this trade." So let's say someone comes in and says, hey, I'll buy 75 contracts. We call this person a market trader, a market taker, or an aggressive buyer. He says, I'll buy 75, and the seller and the buyer for 75 contracts will be matched with each other. And that's a trade. This becomes the new price, meaning the candle opens. Then another buyer comes in and says, I'll buy 50 contracts at the best possible price currently available on the market. Among the sellers who are willing to offer it, and 50 out of 89 contracts are matched with this buyer. Another trade, and the candle moves up because that's the new price on the market. And then a seller comes in and says, hey, I'm ready to sell 100 contracts at the best price a buyer is willing to offer me. In the end, he'll find 73 contracts here, and below that, he'll take another 27 contracts. That's a trade too. And a new price appears and the candle moves down, leaving a long wick from the previous price that was on the market. Now, the difference between the best bid and the worst will be called the spread. As you can see, markets move just like an option does, because someone is willing to pay just a little bit more than what a competitor is offering at that moment. Now let's briefly summarize. The price doesn't move because there are more buyers than sellers. There are always the same number of buyers and sellers. That's a rule. The price only moves because some of them, that is, one side, is willing to accept a worse and worse price than what's currently available just to get the asset right now. And this, my friend, is exactly where the accumulation model begins. The approach is based on action price theory. It reflects the situation of balance and imbalance in the market. You stop looking at the market as chaos as just a bunch of switches or bars. You finally start to see the structure, how they actually work together. If you want to move up to the next level right away, I've prepared a free guide for you with the practical logic of how I got to where I am now. Taken into account these imbalances and possible trades to continue the trend, and I've laid it all out using specific real-life examples and trades that I've actually made. So you can watch and repeat, do the same thing. The link you'll find below this video. Download it, use it, and start earning. Let's get back to our example. Imagine you want to buy gold, and basically you have two options. Either you place a buy offer, meaning a limit order, and wait for your order to be filled at the price you requested. That is, one of the sellers will want to sell you gold at a worse price than what's currently available. So you're hoping that an aggressive seller will place a market order and there won't be enough liquidity so that the price will reach your order and you'll end up buying that gold. In other words, here you're just passively waiting for your order to be filled. The second option, you buy at market price. That is, you immediately pay a little more than the current price. The price, you accept the offer that exists on the market to ensure that your order is executed right now, not at some later time. This is how markets move, by traders who can't afford to wait for their orders to be filled. Let's imagine an example. Let's say there's breaking news about a sudden gold shortage. Central banks from different countries start buying up gold. Gold isn't being produced in such quantities over the year, and all this news keeps pushing gold prices even higher. Well, the first thing that will happen is there will be fewer people willing to sell. So if we look at the order book, in this case, we'll see that the number of people willing to sell at the market price, or even at a price higher than the current one, will decrease. And here's the second point. At this moment, there may be more aggressive buyers who, because of the news, are ready to buy right here and now, realizing that the price will be higher a little later. That means they can't wait and want to get into the asset immediately. That's why it's a pretty common story when the candlestick and the price surge shoot up right off your screen, because they're eating up the liquidity. And a very real and well-documented phenomenon here is that the candlestick literally breaks through the top of the screen. And it's important to understand the key point here, why this happens. It doesn't happen because there are suddenly more buyers, but simply because sellers don't want to sell at the current price, so there are fewer people willing to sell. And aggressive buyers show up, ready to pay more for something they believe is about to go up in value. And here, my friend, is the main takeaway. The market isn't divided by the number of participants, but by how urgent their actions are. When FOMO appears, the price starts to rise. Not because everyone is buying, but because buyers are willing to pay extra, expecting even more growth in the near future. By the way, let me know, have you ever experienced FOMO in the market? If so, in which asset, and what did you do in that situation? Now that we understand the basic mechanics of how price moves, we can identify the two main moments in every auction. The first is an auction in a state of balance, meaning aggressive buyers and aggressive sellers. Overall, they kind of meet somewhere in the middle, at the price that currently exists on the market. This is what's called a fair price. In other words, there's no dominance of aggression from either side. And then, as we already mentioned, some news might come out that pushes the price one way or the other. That is, there's aggression coming from either buyers or sellers, and an imbalance occurs. This is what we call an imbalance. It's easier to just call it a trend, which is actually the most profitable and best scenario in the market when we can make money. This will continue until the enthusiasm of one side or the other runs out, until the news stops and the number of people wanting to participate drops to a minimum. So we can identify two phases in the market. There's the balanced market phase, or fair value area, or the unbalanced market phase, where there isn't a real fair value zone and there's only a trend present. And of course, sooner or later, the market always returns to balance and a balanced price emerges. And the most important thing in all of this, the key factor is volume. If you really look at volume, which is the result of trading volatility, what do you notice? The price spends most of its time trading right in the fair value area, and the strength of the market is actually in the balance. As soon as that balance ends, strong moves begin. That's the imbalance in it. On the other hand, this phenomenon is quite short-lived, but often the most dynamic and promising for trading. And in these imbalances, there's actually the lowest volume, accompanied by price movement. That is, in the fair value zone, in the area of active trading with both sellers and buyers. We always have higher volume there, but less price movement. So in the end, we can sum things up. When all the buyers finally find an aggressive seller who is willing to hold the balance to keep the price within that balance in order to execute their orders more efficiently and create a new fair value situation, that's exactly where the highest volume is traded. That's exactly where you need to look for entry points that will be the safest for you. And if you've noticed this basic supply and demand mechanic, the overall volume, how it is formed, and why this happens from the order book's perspective, from the perspective of news, then you're ready for the main thing. You're ready for the methodology of the Pojaga models. And right now, I'm going to show you how to use volumes in practice, on the chart with real examples. For this, we'll take the gold futures chart and let's say mark off a section from 2026 so we can break it down completely. To do this, I use the fixed volume profile tool and always apply it to the part that is already played out. So in this case, I'll highlight it for you right now. This is the area of the already existing trend, let's say, up until the point when the decline happened. So to answer the question of where the price always returns, it always comes back to fair value, and specifically to the zone of active trading. If you pay attention, you'll see that these two zones at the bottom, in the end, ended up holding the prints. These are the zones with the highest trading activity, where the largest concentration of trades took place. Once this part is done, we highlight the areas again, taking into account the decrease in our volumes. They might be adjusted a little bit, and then we continue further. In other words, we evaluate the next zones where the price might stop. So take a close look. Right here, we saw a reversal, and when we ask ourselves where we're gonna pause. We simply go back to those same zones and say that this is our main target. So after we have a consolidation zone, that is a zone where we traded for a while, look, I've highlighted this zone, taking into account the sideways movement that happened. And if you pay attention, right here we see more trades, more orders that were executed. In other words, we get a consolidation zone between the upper and lower levels, which will indicate the further direction for us. Look, so here's the upper boundary and the lower boundary. And at the moment when this balance, more precisely this equilibrium, is broken, we'll see the next move. So here's the breakout to the upside, and here's the development of that move that followed. As for the question of what happens next, we can't say for sure. In exactly the same way, we plot the volume with the completed trend and highlight the next zones. That is, the initial zone has remained fully relevant for us. This was our first stopping point. But in the process, another zone appeared above, which held us back. I want to draw your attention to the fact that I was evaluating the section up to the start of the correction. So I don't need this part in order to make any conclusions. Accordingly, we test it from one side and from the other. A move to one side leads to a market imbalance and further movement. And then we go through the zones, all the main ones, in the same cycle, in the same order. If we go back to the period before this moment, then this zone will also be defined for us. In other words, the approach itself is always the same. And now, let's clear absolutely everything and see how the situation develops further. So look, we had a drop, it seems like we turned around, and at this point we've gotten some information that it's either a correction or we do have a reversal. You have to pay attention to the breakout that happened and to the retest that's forming right here and now. So consolidation inside gives us reason to assume that we might see a move to the next zone. That is, in this case, we are not using patterns or strategies. We use the only important information on the market. This is volume. Where were the deals concluded? Where were they carried out? At what price? And in what amount? That is, in what volume? This is the very zone of imbalance where we have the smallest zone with volumes. We move through these areas the fastest, meaning that zones with minimal volume are trend sections for us, which get filled very quickly. For example, I can tell you what's ahead. We have two zones ahead, and as soon as we break through the next one, we get a basis here for a subsequent strong move. And now, my friend, I want to show you how to connect these levels to an actual trade, to the concept of compression. In other words, a specific setup that you can use. And for that, we're going to look at oil. Yeah, I did a bit of work here. I've already marked the necessary information, and I want to comment on everything. Look, I stuck to the same principle, highlighting the existing area for volumes and then drawing conclusions from there. Let's go through it step by step. Compression in this situation is when the price forms a consolidation, meaning a balance at a certain level. And with the subsequent breakout, we start working, meaning we join the trend continuation depending on which direction the breakout happened. So in this case, it's an upward movement, and your question was about how to manage the trade and where to exit. I'll get to that a bit later. Just be patient. Right now, we're talking about the entry. The next high volume zone appears here, and accordingly, if the price drops, this is the first target we can focus on. Eventually, we return to the previous zone that was worked through a bit earlier. Next, we get a balance and an accumulation zone between two ranges. So as soon as we break out of it, the next zone is realized, and accordingly, we have a range with an upper and lower boundary. Right now, I want to draw your attention to what's happening in the market. In other words, we had a breakout, we had a retest of this high volume accumulation, meaning this balance zone, and then further movement upward. So basically, to use this correctly in trading, you just need to understand how accumulation forms, that is, fair value or balance in the market, and which direction the breakout happens. In other words, wait for the breakout to happen, and then enter in the direction of the current trend. That is, in a state of imbalance or trend, simply put. As for the question of how to manage all this so you can exit a trade on time, I have an answer for that too. I want to show you two examples. So let's say we entered right here, meaning we had the opportunity to join the market from the squeeze. And right here, we're doing a retest. So on the retest of this zone, besides the breakout where you could have traded the range breakout, let's imagine we just joined in on the retest of this zone with a stop placed outside our volume zone, and we don't know where to exit. My friend, it's actually very simple. You need to find the volatility stop indicator, which lets you manage your trades. That's all you need to keep things under control. Set the length to 20 and set the multiplier here to 2. And as soon as the candle closes outside this range, meaning outside this value, you immediately close your trade, or if it changes color. So here are a few examples for you. Right here, we had a consolidation. As soon as the price reverses, you stay in the trade right up until the candle breaks through. Same thing here. You stay in the trade until a red candle appears. So the red candle appeared right here at this spot. And that's how your trade looks in this situation. So a 7-to-1 ratio is an excellent ratio for this kind of trade. Until the next moment, the trade is still active, meaning the current one can stay open, and you wait to see where it gets locked in. So even if the price drops now, you're already making a profit. That's 2.5 to 1 from the original trade. So the last thing I want to show you in this video are specific examples of my trades, how I trade them, and how I integrate them with my system. In other words, why this approach? Why this model? This approach can be used absolutely in any market and with any trading system. Watch closely. Now we're going back to gold. In gold over the past 6 months, I trade it very often, and I really like it because it brings in good money, good profits. And actually, the most interesting thing is, believe it or not, it all started here. From 25, the middle of 25, I want to point out this zone to you. So even without showing you the volumes yet, I think from the specific examples, you've already noticed what a range means, what consolidation is, when we're trading inside a range. And as soon as we broke out, so here's the breakout, you can see inside where we were forming our moves, and as soon as we went beyond those limits. So as soon as we broke through the previous extremes with a calm stop placed beyond the extreme, we can just sit in the trade calmly. Then, by simply adding an indicator, you set your stop and stay in the position right up until a breakout happens. The breakout occurs right here, and that's where you exit. The ratio is 2.77. But the trade doesn't end there. So after that, we kept working with the client step by step. A correction starts, and we do the same actions again. We draw the volume zone, highlight the most voluminous parts in this range, and there are only two. Well, actually 3. So we highlight them. The first stop appeared at the lower boundary, so we expanded the zone. Taking the further movement into account, the upper boundary appeared. And accordingly, this allows us, once we consolidate above this boundary, usually I use the extremes. In this case, or to put it simply, my approach, let's say it's a trendline breakout. So usually in this case, I can't enter before the breakout. Here it is, the first trade, so that's 1.78. We get it right away. What should we do next? After that, it's the same thing. We stretched and expanded the volume zone, watching how things were developing. Here, it's pure price action, which you can find in pretty much any book. We had a horizontal level that was being tested from the other side, and accordingly, that's an additional setup you can usually use with a breakout of this level, right away. One of the most effective ones. And right here is our point. That is the place where we close out. It's formed right here. So over a 6-month period, we make a profit here of about 14, 7, and 22%. That means we take almost 50% of the gold from this segment. These are the specific examples where we take profits with our clients. But we can switch to a lower time frame and take more trades. We can ramp it up, and trade intraday, because the very principle of price to action and volume always works, and you can make money from it. So I strongly recommend you test this out. Write in the comments if you've tried this before, if you use price to action, and if you found your edge with this approach. Be sure to check out my other videos. There's a video on my channel about oil where I show specific examples. There's also a gold trading strategy where I show how I trade my own deals, which could be useful for you because it's packed with practical information. You can use these right now to start making money. Subscribe to the channel if you want more of these breakdowns, so you don't miss out and don't get marketing junk, but only get useful content. That's all for me. See ya.